I still remember the first time I got my paycheck. When I tore open my first paycheck, I was surprised to find out that a huge chunk of my money is gone due to taxes. I think everyone has their own opinion on whether or not they are over or underpaid the government. That's a topic for another time. These taxes are optional, and trying to hide or not paying your fair share of taxes never really end well. Also, majority of Americans believe it's their civic duty to pay taxes. Disclaimer: this is just a quick overview and a common calculation that I use. Consult your CPA or tax person if you need help on your taxes. This is me, John. On average, most Americans' income is the salary that they receive from their employer. In America, on average, most people are either paid bi-weekly, twice a month, or monthly payroll. Usually, employers subtract a portion of the income for every paycheck and send it to the IRS, Internal Revenue Service. Therefore, after Medicare tax, Social Security tax, state federal tax, jobs healthcare insurance, and 401k contribution, and etc., I take home noticeably less than my pay income, which is called take-home pay. At the end of the year, like most Americans, I will receive a tax form that shows how much money the IRS had taken from my salary. This is called withholding. During this tax return season, Americans usually do their own calculation or get assistance from the tax program or CPA. In the end, if my overall adjusted calculated income tax is greater than the amount that my employer withheld or sent to the IRS, I have to send the IRS a payment to cover the differences. However, if my overall calculated income tax is less than, then I will receive a tax return or tax refund for the differences. Here's a quick overview on your overall calculated personal income tax. Taxable income includes, among other things, your wages, salary, bonuses, taxable Social Security, capital gains, unemployment benefits, alimony received, and taxable retirement plans distributions. Now, an individual total personal income before accounting for taxes or deductions is what the IRS considers gross income. Next is the AGI, or adjusted gross income. This is all your taxable income minus all your adjustment to the income. These adjustments include such things as deductible traditional IRA contribution, student loan interest, businesses, moving expenses, and alimony pay. For the deduction from the AGI, they are either standard deduction or a collection of itemized deductions, whichever is greater. For itemized deductions, it can include such things as charitable contributions, medical expenses, if greater than 10% of your AGI, or 7.5% if you are 65 or older, mortgage interest, and dependents, children you care for exemption. According to the 2016 Tax Foundation, max personal exemption is $4,050, and deduction for single is $6,300. Married jointly filing is $12,600, and head of the household is $9,300. After all of this, the remaining amount is called taxable income, based on the U.S. marginal tax brackets rates. This means that portion of your income are taxed at higher rates as the amount of your income increases. For example, average American household make about $52,000 a year. Based on marginal tax rates for single filer, you will pay 10% for your first $9,275, 15% between $9,275 and $37,650, and 25% between $37,650 and $9,150. Click here for an in-depth basic calculation for single and married jointly filing. For some Americans, they can further reduce their taxes by fulfilling certain tax requirements for certain credits, such as Earned Income Tax Credit, Child and Dependent Care Credit, American Opportunity Tax Credit, Lifetime Learning Credit, Advanced Premium Tax Credit, and Savers Credit. After all of these deductions, exemptions, and credits. The amount you have now is the federal taxes you owe to the IRS. By comparing this amount to the amount that your employer withheld from your pay, you can find out if you will receive a refund or a tax return, or you need to pay additional tax. Here is a quick review on how a person's income tax would look after calculation. 1.45% went to Medicare taxes, 6.2% went to Social Security, 1% to 13.3% depending on your taxable income went to state income tax for California, and 10% to 39.6% depending on your taxable income went to federal income tax for single, married, and hetero households. The remaining percent is your after-tax income to take home. If you need to know more about taxes, please go see a tax specialist or information on the IRS tax website.